Hi, this is Lisa Featherngill, Head of Strategic Wealth and Business Advisory at Comerica Wealth Management. I'm here with Melissa Linn, who's a Senior Wealth Strategist, for part two of our series around the One Big Beautiful Bill, or as we're going to talk about it in the future, OB3. Today, we're going to focus on the individual tax provisions. So let me go ahead and kick it over to you, Melissa.
Thank you, Lisa. We are starting with the permanent enactment of the brackets and the rates and most of the itemized deductions that were in the Tax Cuts and Jobs Act. Now, when I say permanent, keep in mind that can always change in the future. We are not really permanent, but as for now, that's where we are. We have our new auto interest for $10,000 potential per year for 2025 to 2028. That is for new auto loans for autos assembled in the US. It could also be something that's refinanced as long as that base principal doesn't increase. We have a new senior deduction through 2028 of $6,000 and a charitable above the line deduction, single for 1,000, married filing jointment for 2 for our non-itemizers beginning in 2026. So that's pretty exciting. Our state and local tax deduction increased from 10,000 to 40,000. I'm going to put a little caveat on that for Lisa to discuss later. And then our estate and lifetime gifting increased up to 15 million in 2026, which is really a continued inflation for where we are now. More planning on that later. Lisa, can you share some of the opportunities and pitfalls that we also have in this bill?
Sure. Some of you may remember the alternative minimum tax, especially from prior to the 2017 Tax Cuts and Jobs Act. For high income earners, it was an additional tax. Basically, what it did is it reduced the benefit of a lot of the itemized deductions. So we have good news and bad news here. In the 2017 Act, it increased the exemption from the alternative minimum tax and gave you a really high income level for phase out of that exemption. Under the new law, we still have the high income level for the phase out. It's $1 million if you're married filing jointly, $500 if you're single, and the exemption stays the same. The bad news is that the phase out goes twice as fast as it did before this new bill. We have a new tax preferred type of savings vehicle for children called Trump accounts. For children born between 2025 and 2028, the government is going to fund these with $1,000. And then starting July 4th, 2026, parents can contribute up to $5,000 a year. So they're tax preferred. There are very specific rules around distributions once the child turns 18, but it's another funding vehicle. Under this new law, a lot of those deductions that Melissa was talking about have different phase-out rules, and I'm going to show you a slide. We put something together graphically to show you the phase-outs because they vary for each deduction. Our itemized deduction limits, there are two things. One, if your income is at the 37% bracket, you start losing itemized deductions. So once you have a dollar over that threshold for 37% bracket, you start losing itemized deductions. In addition, there is a new floor on charitable contributions, a 0.5% floor. So if you make $100,000 a year, you lose the first $500 of charitable contributions. Betting losses for those individuals who like FanDuel and all those types of things, like my son. It used to be that you reported your betting income net of the losses. And then with the 2017 Act, you started having to report your income, and then your losses were itemized deductions. Under the new law, you can only take an itemized deduction for up to 90% of your losses. And then finally, there really is something in this bill for everybody. They increased the refundable version of the adoption credit to $5,000, meaning even if you owe no tax, you can get that $5,000 back. And for child care credit, the maximum credit is $2,200, but up to $1,700 can be refunded, and that changes annually. You'll see the phase outs of the different deductions. So again, it's all over the board. So it's important to note here, if you are, let's say you are married and making $500,000 a year, you might think you're in a 34% tax bracket, But actually your bracket's much higher because for every dollar of income over 500,000, you're losing 30 cents of your state and local tax deduction. You are losing part of your qualified business income deduction if you're a business owner, or if you've got tips, you might be losing part of that. So multi-year tax planning is now more critical than ever in order to time your income and deductions for tax efficiency. I used to think that you needed to do a 1 or 2 year tax projection. I really think it's 3 or 4 years now, because the different phase outs, the different effective dates, all make these planning discussions more and more important. Estate planning, as Melissa mentioned, we now have clarity. We know that we've got a $15 million exemption beginning next year, adjusted for inflation. We don't have to worry anymore about sunset or the exemption cutting in half. But for those individuals who will have taxable estates, lifetime planning around wealth transfer still makes so much sense. Melissa?
I'm really excited about the additions to the 529 plan, Lisa. So beginning in 2026, we could use, this year you can still use 10,000 for pre-college expenses. Next year that goes to 20,000. They also expanded the use of this amount of any 529 plan, to the items after July 4th, 2025. So that includes homeschooling, SAT prep, and exam fees, tutoring. But mom, you can't get paid for tutoring. It's got to be a non-related individual. Curriculum, textbooks. It also includes certifications and apprenticeships. So anybody going to get any certification, like the Certified Financial Planning, the CPA, it could be an auto mechanic certification, the exam prep, the exam itself, and the maintenance continuing education are now included. The last piece that they expanded is for special needs children. And so it allows payment for therapies such as speech, occupational, anything that can help them be more productive in life. And I think that's pretty incredible. Lisa?
Yeah, I'm really excited about capital gain planning opportunities. We talked a lot last time about the qualified small business stock gain exemption. But if you're not a business owner, if you have a gain saved from the sale of stock, there are other ways of deferring and planning for that gain. So for example, the Opportunity Zone program. With the new program, which begins January 1, 2027, you can invest that gain into a Opportunity Zone investment. If you hold it for 10 years, 10% of that gain will be eliminated. If that investment is in a rural zone, 30% of that gain will be eliminated. So you have 5-year deferral, you have partial elimination, and whatever you invested in that Opportunity Zone investment, if you hold it for 10 years, all of that appreciation is tax-free upon sale. So very exciting. And we still have 1031 exchanges for real estate. We have installment sales. We have charitable remainder trusts. A lot of great planning opportunities still available. A couple things I want to mention on the charitable planning. One, that provision with the 5.5% haircut doesn't take effect until 2026. So high income taxpayers may want to consider pre-funding some of their charitable contributions this year. In future years, they may want to consider bunching up those contributions into something like a donor advised fund or a charitable trust, so they can make a one-time large charitable contribution, take that 0.5% haircut one time, and then make charitable contributions from there. For other more moderate income taxpayers, they can take the standard deduction and the new non-itemized deduction for charitable contributions. So it's a win for the taxpayer and a win for charity. Melissa?
Well, unfortunately, I'm not ending on a high note here. We are losing our clean energy credits. So if you're like me and you needed a new HVAC, or you need a new water heater, or you were planning on buying an electric car, this is your year. Please watch your ending dates. Though if you buy the car this year, you can still put in the charger next year. So there's a little bright light at the end of the tunnel. Lisa?
We really recommend reviewing your planning at this point, to consider the impact of all these new changes. Melissa and I wrote an article about the tax bill that's available here at comerica.com/OBBB. Contact us with questions, and just know that we're going to have another session coming up where we're going to go more in depth around several of the planning opportunities with this new bill. Thanks.